Okay, our last paper for this session will be presented by Xiaoyan Zhang from Tsinghua University. And she's going to talk about the China-U.S. equity valuation gap. Xiaoyan, you have 20 minutes. Go ahead.
Okay. Do you guys see it?
Yeah, I go. Great.
Okay, good. So today I will talk about China-U.S. valuation gap. And my co-authors are here to Bekaert from Columbia, Shuojia, and I were both from PBC School of Finance. So let me first explain what do we mean by valuation gap. So here I'm showing you this time series picture. I have, from 1995 to 2019. Quarter one, well, actually it's 2018, quarter four. And we have three lines in this picture. We have the price earnings ratio of China, which is green, and the P ratio for United States, which is red, and emerging market as in yellow. So what's the valuation gap? We're looking at price earnings ratio. You can see that China and the United States, the P ratio, they're quite different. Before 2010, China P ratio is significantly higher than the US number. Then after 2010, 2009, the green line, actually China is below United States. We tend to call it the first part as valuation premium and the later part as a China valuation discount. So what we have in mind is very simple. If we look at global capital market, the general idea, there are two ideas. The one idea is if the market is perfectly integrated, then the valuation for a similar firm in different markets, they should have similar price earnings ratios. And right now they're not. Okay. And the second opinion from previous literature is that emerging market firms receive lower valuation than developed market firms. So that's why we have the yellow ones under the red ones. But China as an emerging market is quite different from the other emerging market. So this is what we mean by valuation gap at market level. I'll also show you what happens for sector level. So here I pick 6 different sectors. On the left, I have 3 sectors with very high valuation in China, but less valuation in the United States. Those are healthcare, equipment and services, aerospace and defense and financial services. And on the right, those are the sectors with very high, not very high, but higher US valuations than those in China. So using this picture, I'm trying to show you that valuation gap not only happen at the market level, there's a lot of cross-sector differences in valuation gap. And then finally, I'll show you the last piece of valuation gap. I have 6 firms here. The green ones are the China PE ratio, and the red one are US PE ratio. Those are firms, Chinese firms, and they're listed in China and in the United States. And you can see the price earnings ratios in China, they're always higher than those in the United States. So you might wonder why there is this valuation gap at market level, at a sector level, and at firm level. And we think this is a very important question to answer, given that China and the US are the 2 largest economies in the world. So what we do in this paper actually is very simple. Very, very simple. We ask a very simple question. What drives the time series and the cross-section valuation differentials between China and the US? And why is this important? I mentioned China and US are very important economies. That's number 1. Number 2, China as emerging market has been trying very hard, but very cautiously over the past 20 years to open its capital market to the world. Did that really help the market integration? That's something we want to find out. Okay, so those are the reasons we focus on this particular research question. And we have 3 hypotheses for this question. Number 1 is changing sector composition hypothesis. Maybe, there are some shifts in the industry structure. That's why they're, valuation gap differently over time and over different sectors. And the second hypothesis is about growth prospects. China was like double-digit growth before 2009, which might explain China premium. And then afterwards, the GDP growth becomes 6%, 8%, 7%. Maybe that's why we have a China discount. And the third hypothesis is about the liberalization and development from the China side, because U.S. has been quite stable. So those three hypotheses will be examined in our research. Okay, now I'm going to show you how do we think about everything fitting into the literature. Our paper is connected with lots of previous papers. There are papers on market integration. There are papers looking at A share, B share premium, including Kalok's paper. And there are papers on valuation differentials. And then we have a paper on Chinese equity market. Also, again, Kalok has a paper. So what's our contribution? We take the perspective of valuation ratio instead of returns, because we want to understand what drives the valuation ratio differentials. And then we want to focus on the regulation changes. We want to focus on the international accessibility. We want to understand all those policies. Which ones? Whether, it's a QFI, QD, II, and, all of those things. Which ones are pushing the valuation ratios to converge? Okay. All right. So that's the motivation part. Now, the empirical parts and the framework part are extremely simple, so I'll go relatively fast. Our framework is based on Gordon model. Gordon model assumes if we have constant cash flow growth rate and discount rate, and then, earnest yield reflects the difference between discount rate and the cash flow growth rate. You might notice that the subject here is earnest yield, which is the reciprocal of price earnings ratio. Okay, so to us, it's kind of equivalent. And given Gordon's model, BHLS, this is a Bekaert, Harvey, Lundblad, and Siegel. In 2011, they take Gordon's model, they look at segmentation of the global market, they extended the Gordon model by incorporating stochastic discount rates and growth shocks. Here, I'm not going to explain all those notations, but I'll tell you, in their derivation, price earnings ratio will become a function of the delta W, which is the global discount rate, and GOW, which is the global growth opportunity. So price earnings ratio for country C, sector J at time T is a function of global discount rate and the global growth stock. Now, given earnings yield is reciprocal of PE, it is also going to be a function of global discount rate and global growth opportunities. So that's the theoretical framework. Now, how do we incorporate our empirical specification here? So what we do is very straightforward. We collect information for firm I first. Then we add them up to portfolio level. This is a portfolio J. Our earnings yield is equal to, on top, every individual firm's belong to the particular portfolio J, total annualized net income, and divide by the market cap of all the firms in this particular portfolio. Like I mentioned, our subject of study is earnings yield. It's not price earnings ratio. Why is that? Because earnings yield is, P ratio is positively skewed, and earnings yield has better statistical properties. So our empirical specification is in the next equation. Let me be slow here. On the left, I have difference in earnings yield between China and the United States at a portfolio level for each quarter. And then we want to explain the dynamics of overtime cross-section, right? We want to explain this difference in earnings yield by a bunch of competing hypotheses. And those hypotheses, it doesn't matter whether it's discount rate or growth prospect, we represent them as X, okay? But I have diff X on the right because I'm looking at the difference in those axes between China and the United States. And of course, we control a lot of variables from previous literature. And then we estimate this equation using panel regression, and the standard errors are double clustered. So that's our empirical specification, very standard. In the end, we want to see which of those x's are the driver for the difference in earnest yield. Which ones are the most important ones? Okay, before we jump into the empirical result, I also need to add on to one more layer, because I mentioned that before 2009 it's the China premium, and after it's the China discount. So we wonder whether there is a structural break in the data. So we use the test from Bai et al, and we do document a structural break in 2009 Q3. So we modify our regression by adding in a break dummy. Then the idea is if X is able to explain the differences in earnings yield, this gamma coefficient in front of this time, the structural break will not be significant. Now we're ready for the empirical results. Our data are from very standard sources, including Sysma, Wind, and so on and so forth. I'm not going to read. And then our sample coverage is from 1995 to 2019, which tells you that we took our time writing this paper. And then we adopt filters from Liu, Stanbao, and Yuan. Okay, now we're going to examine our three hypotheses, starting with shifting in industry structure. My co-author forced me to present this picture. So I'll tell you what this is, and hopefully it can help you to understand why we care about this. In this picture, we have in the x-axis, the average earnest yield differential for the first 5 years of the sample. And the y-axis are the earnest yield differential for the last 5 years of the sample. So if there's no shift in the valuation ratio, they should all line up on the diagonal, right? There's no change. But there is one sector that's very special. You can see the banks and life insurance, they're pretty far away from the diagonal. We're wondering, is that because banks and life insurance, they were not important before, but become important after, and they are driving the difference in valuation ratio? Why do we think that way? Well, because financial services, banks and life insurance sector, they're super important for economy like China. I show you the weights calculate using market cap. You can see before 2006, they're less than 10% in terms of market cap. Afterwards, it's very close to 30%. Is this one sector capable of explaining the variation over time? Well, let's see. So for the industry structure hypothesis, we actually did a very simple decomposition. We take the difference in earnings yield and decompose it into two parts. The first part, we keep the industry weight the same. We're focusing on the earnings yield difference between those two countries. So that's called diff in valuation. And then for the second term, we fix the earnings yield of the United States, and we look at the weight difference between industry structure of China and the United States. And we call this difference in structure. Now, if difference in structure is the main reason for time series and cross-sectional variation, then the second part should be explain most of the variations. And you can see at the bottom, the difference in valuation accounts for 99% of the total variance across time, across portfolio of diff EY. And difference in structure is only explaining 1%. So this is to say hypothesis 1 probably is not supported by the data. The difference is driven by valuation, not the structure of the industries. Okay, that's the hypothesis number 1. Let's look at the hypothesis number 2. Number 2 is about the growth prospects. And here I show you the growth GDP and the sales growth expectation. I use this figure to make 2 points. Number one is, you can see they're kind of downward sloping, right? GDP was 10% and above, and before 2010 and afterwards, it's stabilized around 6%. So it is decreasing. And of course, there's a dip of global financial crisis. And then for the sales growth expectation, same pattern. I also want to tell you that for the sales growth expectation, we have to use analyst data, and that data only starts in 2003. That's a hypothesis 2. I'll put hypothesis 2 and 3 together and explain them in a minute. Now, hypothesis 3, variables.
5 minutes.
5 minutes, okay. Hypothesis 3 is based on discount rate variables. We look at the market development, and those variables, I'm not going to read it. They're all very common faces. You know them all. And then we have financial openness. This is where the Chinese regulators, they try very hard to open the market step by step. Okay, so we have openness regulation dummy, we have international accessibility, and so on and so forth. I'll tell you international accessibility in a minute. And category 3 is investor base, whether it's a state, institution, retail, so on and so forth. So let's talk about international accessibility measure. How do we measure that? I'll take an IA1 as one example, as is shown in the green line. So we have 4 dummies. Number 1 is dummy whether the firm has B share, and then the firm whether dummy for H share, dummy on ADR, and then dummy on whether it's in mainland Hong Kong Connect. So the idea is, we add up whether they have access for foreign investors to be shareholder. Okay, and you can see it's slowly increasing over time. We calculate the dummies at firm level, we aggregate them to portfolio level, and then to the market level. It's increasing over time. All right, let me show you the empirical results. Finally, we have 3 minutes left. All right, like I said, the empirical exercise is very simple. I have this regression with 33 variables from 2 different hypotheses. There are too many. So we use a very well-known statistical procedure called PC guess to pick the most important variables. And they are in 4 different categories. Category 1 is for hypothesis 2. Category 2, 3, 4, they're for hypothesis number 3. So I'll tell you, starting from the bottom. So if we have those 8 variables selected, we can explain 33% of the variation, which is not small. Okay, but then we want to know which ones are important. Okay, we have the coefficient here, significance here, and we also have variance decomposition. The ones that are important, they should have account for more of the variance decomposition. So growth is important, 5% of variance. And then for financial development, adding together 10%. Now, when we talk about financial openness, this international accessibility, this is the market cap of B share, H share, and the ADR over firm's total MV, which is measuring how much foreign investors can hold the company. That one is accounting for 55% of the total variation. Now, for the regulatory financial openness, you might wonder, what's that? Well, there are 6 regulations like the QFII, RQFII, QD, Hong Kong Connect. There are 2 Hong Kong Connect, and there is MSCI inclusion. So that is 13% as well. At the end, we have turnover rate. Some people think that this is a liquidity measure. Some people think it's retail investor proxy. Here, I'm just going to say it's a turnover rate that explains 12.4%. Okay, now here's the model fit. Does our model explain the dynamics of valuation ratio nicely? This is a differential valuation ratio. The green one is the data. The dotted one is our model prediction. So we think we are doing a great job here. Now, if we move on to the most recent 15 years, 2003 to 2018, you can see that the growth actually is picking up and accounting for about 30% of the variation, and the RA2 international accessibility still count for 42.5%. We have a many robustness check to relax the integration hypothesis and assumptions about the betas. The results stay. So let me conclude. What we do in this paper, we examine the dynamics of the valuation differentials between China and the United States over time across different portfolios. And we find China premium before 2009, China discount afterwards. And out of all those explanations, we find financial openness and a change in growth expectations are the most important contributors. All right, that's all I have. Thank you very much. I'll stop share.
Thank you very much, Xiaoyan. Our discussant is Kalok Chan from Chinese University of Hong Kong. Kalok, you have 15 minutes. Go ahead.
First of all, thank you for inviting me to discuss this paper by Xiaoyan along with Baker and Kerr. This paper on this China equity valuation is really related to some of my previous and current work, and so therefore I really enjoy reading the paper. Actually, that the paper is quite long. Including some online appendix, like 100 pages. But Xiaoyan had done a very good job, really simplifying the whole presentation. And then she keeps saying that things are very straightforward, but it's not really as straightforward as what she say. But anyhow, I really enjoy the paper, and that really find that some of the results are really quite interesting. So let me elaborate again the motivation of the paper. I think Xiaoyan has done a very good job in explaining why this paper. First of all, I mean that they observe this PE ratio of the China relative to the U.S. is very high before 2009, but it has really come down, and now it's even lower than the U.S. And that is really the pattern for China is really different from the emerging market. Because usually the people who think about the emerging market, the valuation will be lower than the developed market, like the U.S. But clearly that the U.S., the China is really different. But now that it seems to be a more reasonable valuation than before. They advanced 3 hypotheses to explain that China valuation or change of the valuation over time. First is the change of these industry sectors. As Xiaoyan mentioned, I mean that there is really the change of the composition of sectors. Maybe there are really less of this higher PE sectors for China market, and so that's what it really pushed down the valuation overall. The second hypothesis is that there's a slower economic growth after 2009, and so it used to be the double digit, but now that it is really less than that. And third is that the market had really been liberalized over time on a gradual basis, although that liberalization, certainly we'll talk about that again, because this liberalization usually we think that this should really be pushing the valuation up rather than not really the way down, because if you allow more foreign investors to come in, I mean that it should really push up the valuation. But of course, this is really the way. This is just a different direction for the China market. So in terms of methodology, they studied the earnings yield differentials, or what they call valuation gap between China and U.S. Again, they use the earnings yield differential, not with the PE, because the earnings yield differential have a really better statistical property. And they try to really look at the determinants of the cross-sectional and time series variation of these industry sectors or these industry portfolios. So they use various explanatory variables. Some variables are constructed at the market level, some are constructed at the sector level. So there are 4 categories of variables. One is the growth prospect. Second is the market development. The third is the financial openness. And the fourth is the investor base. So in terms of analysis, the methodology, so it's a kind of panel regression. They stack up all this data across for these different sectors, portfolios together over time, and then run the multivariate regressions, and then using this set of explanatory variables. Yes, so because there's quite a lot of explanatory variables, so therefore that they also have this algorithm, PC-GAS, I mean, to help them to really finally select what are really the set of explanatory variables that explains this earnings yield differentials the best over time, and also that over the cross section. And then I also would like to mention that they also, besides the earnings yield differentials between the China and US, they also have analysis looking at the Chinese earnings yield only, which is basically that if China market, if they are not really well integrated the US market, then in that case that then might be that it's also that more appropriate to look at the Chinese earnings yield alone rather than to look at the differential. And then they find the results are quite robust. So anyhow, these are the results. They find that the valuation gap between the China and US is not driven by this sector structure change, but rather it is really driven by the valuation changes within the sectors. In terms of what variables explain the well, overall, these different explanatory variables can account for 33% of total variation in the earnings yield differentials. And financial openness variables have the largest explanatory variable, has the largest explanatory power. And among the financial openness variables, the key variable is IA2, which is the market cap ratio represented by the B shares, H shares, and ADR. They've done a bunch of robustness tests. And then overall, I think that this paper making a important contribution, as that this is really that representing a comprehensive analysis of time series and cross-sectional dynamics of the valuation gap between China and US, and also that it highlighted the importance of this international accessibility on the valuation in China. Although again, that it does contradict our conventional wisdom that higher accessibility should increase the valuation. So I think the paper is quite extensive, as I mentioned, that had a lot of analysis. So my comments are more probably on the bigger picture rather than on the detail part. So first of all, try to understand about the paper, right, and why they study the Chinese stock valuation. And of course, that this Chinese stock valuation, we know that it was high before. And there are various reasons that for that high valuation, because we know the China market is dominated by retail investors. There's a lack of alternative investment opportunity, and that it is full of irrationality, speculation, and short-term trading, and also there's a lack of short share opportunities. So there are many papers written on that before. But however, what we have observed is now the China stock valuation become lower. It was not that low, but it was definitely lower than before. What can really be the reasons? The first is that there are really tighter monetary policy. It's not as tight, but definitely that is relative to the US, it's still really tighter. Second is the lower growth rate for China economy. When I say lower, it's still high. It's not double digit, but it's still higher than the US. So therefore, that actually on that sense, right? That it might not still be able to explain why the China valuation is lower than the US. Third is that now they're becoming more international accessible. So we have this Stock Connect program connecting the A-share market to Hong Kong. We have also the A-share inclusion in MSCI. We have also this QFI. But exactly, we don't really know that how that this international accessibility opening up the China market will affect the valuation, especially in the way that we really observe. And that is really something I think that we'll talk about again. And finally, that there's also that the availability of short sell vehicles. For example, that now that we have short index stock index futures, although that the Chinese government had really tightened some kind of rules on this stock index futures. So their trade volume for stock index futures had really been curbed since 2015. But otherwise, the stock index futures, it should be a medical, right? It should be a good explanation, and then to adjust, to correct for any of the overpricing in the stock market. Another thing that I look at the paper is that want to point out is that of course, that the China market, that it had been over so-called quite high valuation, but then there's really a group of Chinese stocks which are really not that high valuation, which is the H shares. So these are really the Chinese stocks listed in Hong Kong. And so therefore that this diagram, if you look at the blue line, that is the PE ratio for the H shares. It has really been below the H shares and also below the US. So in fact, if you look at the H shares, it's more like the emerging market. And that is also more consistent with the conventional wisdom that, the emerging market stocks are at the discount relative to developed market. And I think that I also show is that this is a P differential between US and A share. And I had extend to 2021, which is now. Actually, that now you can see the P differential between the two markets, the US market and the A share market, had reached the highest. And so therefore that now that's the question, well, what valuation is correct? That is the US valuation correct or whether it is a China valuation correct? But so therefore that it is also something that we can think about when we look at this the earnings yield differential or valuation gap, right? And therefore it is really relative to the US market, and therefore that whether that US market is really the right benchmark or not.
4 minutes, Kalok.
4 minutes? Okay. So my comment, so the question is that why did we study the US, why did we study valuation gap? So of course that the US and China are the two largest economies. US is a developed market and China is an emerging market. So we have more Chinese companies listed in the US, and so therefore maybe that is the reason why that now the Chinese valuation is closer to the US. And also that we have more US or international investors investing in the China market, and so therefore that the pricing from this international market is also applied to the China market. That's one way that we can motivate this study of the China-US valuation gap. On the other hand, this paper is following the Bekaert's previous paper in 2011. They studied the valuation gap across the developed and emerging markets. Although they really study the absolute value of the valuation gap as a measure of equity market segmentation. So now if we really use this valuation gap and then to apply the analysis of China market, and then we have to ask the question whether that is right to use the US as a benchmark, because it all comes down to whether that this China is really integrated with the US market or not. If the two markets are almost perfectly segmented, they are not really integrated, that might not really be that appropriate to study valuation differential. And also furthermore, that this is really assuming the US valuation is correct. For example, I just showed that right now that this differential is really reaching the highest point. And so now the question is whether the US pricing is correct or not, right? That's people always ask whether the US market is really now, overvalued or not. So at the end, then we have to ask ourselves, if we want to look at the China's valuation, whether that should we really look at this valuation gap or whether should we look at the China's earnings yield? And that in fact, Xiaoyan probably have not really present. They find that the variables are bad, in fact, better is explain the China's earnings yield than the valuation gap. So therefore, that might be we have to think about which model is really better. So I have some other additional comments. So first of all, the paper motivates with the reversal earnings yield differential after 2009. And clearly, this is really a time series pattern. But of course, that then in that case, that I might say that they might want to look at how those independent variables or explanatory variables that they look at, how that they have really changed over time, especially that before and after 2009, so that we can really see a better correlation between these explanatory variables and this reversal of earnings yield differential. And more importantly, I keep asking the question, how much of the explanatory power due to this time series variation rather than due to the cross-sectional variation? And second comment I have is that some explanatory variables are constructed at the country level and some are at the sector and portfolio level. And then, but in the analysis, they try to compare the explanatory power. So, which I'm not really sure whether that are they strictly comparable, because that clearly for the country level measures, they are not able to really to explain the cross-sectional variation. And so therefore that how that we make these comparison on the same yardstick. My last set of comments are additional comments. Again, this earnings yield differential between China and U.S. is kind of quite interesting. It moved from a negative to positive. So now the question is that, are the market segmentation for China considered increasing or decreasing? Second is that the paper has really been based on the industry portfolios. This has really been following Baker's previous paper, because they have looking at a set of emerging markets and their markets, and so therefore looking at this industry indices. But however, now that the Xiaoyan, the paper, they have individual stocks, because they construct portfolios based on individual stocks. So in that case, that they can simply look at based on analysis of individual stocks, and so in that case, that they can really exploit further variation of this earnings yield differentials and also explanatory variables. And sorry for a typo. So finally, about that financial openness. So this is really key variable, and that's really a major driver in explaining the valuation differentials. Now my question is that how much of the explanatory power is due to time series variation? Because it is clearly something that Xiaoyan has also keep emphasizing, that the Chinese government has really gradually liberate the capital market. And now the question is that how much do they really contribute to the reduction of the valuation differential over time? Again, this is the puzzling result that we still don't understand why that the opening up the capital market will really reduce the valuation or we increase the earnings yield. We still don't understand the reason, but I think that's something that certainly, I mean, a lot of studies should really understand furthermore how that the increased participation of foreigners will actually reduce the valuation of the China market. Of course, that it is really making it probably more reasonable valuation, but the mechanism behind it, I think that we probably would want to understand more. I think that's all I have. So overall, I really enjoy reading the paper, and then I really learned quite a lot, from the analysis. Thank you very much.
Thanks, Kalok. Xiaoyan, you want to respond quickly? And there are two questions on the chat, one by Johan and one by Longwei. Go ahead.
Okay, first of all, I'm really grateful for Kalok. This is a very, very insightful discussion. Many of the points I raised myself, including like, why do we look at the differences? Why don't we just look at China before? But we were still hesitating. Now with your comments, we probably would move on to looking at only China. Now, I only want to address the other thing. You were asking, how come the international accessibility have a positive coefficient, right? Now, the difference, it's sometimes positive, sometimes negative, as you mentioned. So the sign in front of IA, international accessibility, it's hard to interpret because it could be positive, it could be negative. But I do want to cite one thing. If you look at the China part, only China, earnings yield part, that coefficient is positive, meaning what? If the firm has more foreign investors present, it's going to increase its earnings yield ratio, lowering its price earnings ratio. So let me put that in plain English. If you have more foreign investors involved, the valuation in China, the PE, is going to be higher. No, sorry. She'll be lower. She'll be lower than before. See, this is a very confusing. And I think, you keep saying that this is, interesting and trigger why, China now is before it's higher and afterwards it's lower. I think the Chinese investors, compared to other emerging market investors, they're very bullish and very speculative. But that's all I'm going to say as of now. Please send me the discussion slides. I think it's very, very helpful. Really, really appreciate you put so much thought into this.
Okay, Johan has a question. Why does the study focus on China versus US instead of looking at an international panel? Doing the latter will result in more time series and cross-sectional variation.
Okay. Why do we focus on China and the United States? Well, I have a private reason and a public reason. The private reason being that, a lot of Chinese firms are thinking about listing. And when they make choices, they choose between China main board, and then they think about Hong Kong as well, and they also think about the United States. And when they make the choices, they notice the price earnings rate, the valuation ratios are quite different across different exchanges. So my private reason is to understand how firms make decisions, understanding the valuation ratios, differentials across different countries and make the choice. That's the private information reason. And why do I focus on United States and China? The public reason is, like I said, and the Kalok echoed, because those are, the two largest economies, and China present some of those peculiar properties in terms of valuations and has so many stocks, and the market cap is quickly increasing. We think it's very important to understand those two countries, of course. But there are other papers looking at valuation ratios all around the world. That's BHLS 2011. But they didn't look at emerging market. And here we're looking at the largest emerging market. And there is another question.
Yeah, it's by an I think Long Wei Cheng. Is the size of the market considered in the analysis? He means the number of stocks available in the market. I guess the initial stocks listed in the Chinese market tend to be large SOEs. Then the number of stocks went up. There are more private firms. This structural change might be driving the valuation changes.
Very good. We actually include a number of firms as one of the control variables I didn't talk about. Yes, we do consider number of stocks and the growth of the market over time.
Okay. Any other questions from the participants or the panelists, attendees? We still have a couple of minutes. So just one question, Xiaoyan. And I guess, do you consider like the accounting rule changes? I guess maybe many years ago, the earnings number could mean very different from the earnings number now. As a company goes to have an ADR, has more cross-listed shares, then maybe they are more aligned to international standards, right? So that may drive the changes in the gap that has nothing to do with fundamentals.
Yes, we do. We do consider, those are under the category of market development. So this is a part of information environment, right? When the Chinese firms do the split share reform and adopt new accounting rules, that happened mostly during 2005 to 2010. So we have a regulation dummy for the development. And also this information will be incorporated into the quality of the analyst, right? We include a number of analysts, we include the forecast errors and dispersions as variables in one of those many tables. Yes, we do consider that.
Okay, thanks. All right. Xu Feng, could you please explain a bit more the variable selection by PC gets? Maybe, just
quickly,
60 seconds.
Quickly. So for PC gets is a statistical empirical approach. The first step is you have all 33 variables in one regression, and then you pick, the ones with somehow significance and, with T higher than 1.5, and then you put those, suppose that should give you 10 variables, you put them together and do another, including all of those 10 together, and then pick the most important ones. But of course, every single step you do, you have to think about how much explanatory power you are losing. Here, I can give you the number. If we have all 33 variables in there, our R-squared is 39%. Now, with only 8 left, we're still explaining 33%. So we're losing 6% of explanatory power, but the majority ones, the most significant ones, are staying.
Okay, all right. So thank you very much, everyone. So it's 11:45 almost. We're going to end this session. So please join me to thank all the presenters and the discussants for a great session.